In private equity fund operations, capital calls are a routine but strategically important mechanism. While the process itself is standardized, issue a notice, receive capital, deploy it. The timing and structure of those calls can vary significantly depending on fund strategy, portfolio pacing, and LP preferences. Most firms aim to balance the capital needs of the portfolio with the liquidity management considerations of their limited partners, LPs, and increasingly some are using capital call lines of credit to help manage that balance. Typical considerations around capital call timing fund. Managers generally time capital calls based on a few core drivers. Deal execution. When a transaction is imminent, capital is called to fund the equity portion. This is the most common trigger. Portfolio support. Follow-on investments, management fees, and other fund-level expenses may also require capital. Fund lifecycle. Early-stage funds tend to call capital more frequently as they build out the portfolio, while mature funds may shift towards supporting existing assets. At the same time, LPs often have their own internal liquidity schedules and constraints. Many are managing commitments across multiple funds and asset classes, so predictability and transparency in capital calls are generally appreciated. Using capital call lines of credit. Some funds use capital call lines of credit, also known as subscription lines, as a tool to bridge timing gaps. These facilities allow the fund to draw on a short-term loan secured by LP commitments, and then repay the loan with a capital call at a later date. This approach can offer several benefits. Flexibility in deal execution. Managers can close deals quickly without waiting for capital to be wired. Smoother LP experience. LPs receive fewer capital calls and more predictable timing. Operational efficiency. Reduces the need for urgent or fragmented calls. However, there are trade-offs. Interest costs on the line accrue to the fund, and depending on the structure, may impact net returns. Some LPs also prefer direct capital deployment over the use of leverage, so transparency around the use of these lines is important. Structuring calls. Thoughtfully, there's no single right way to time capital calls, but a few practices tend to support smoother operations. Advanced forecasting. Funds that model capital needs over a 6 to 12-month horizon can better align calls with actual deployment schedules. Tranche-based calling. For multi-deal pipelines, calling capital in stages can help match inflows to outflows more precisely. LP communication. Informal heads-ups or quarterly pacing guidance can help LPs plan liquidity without surprises. Sizing and frequency. Some funds prefer fewer, larger calls to reduce administrative burden, while others opt for smaller, more frequent calls to align with LP cash flow cycles. Illustrative example. Consider a fund with 500 mailers in commitments and a pipeline of 3 deals totaling 150 mailers, expected to close over the next quarter. The manager might choose to draw 75s from a capital call line to close the first deal immediately, then issue a capital call in 45 days to repay the line and fund the remaining deals. This approach allows for timely execution while giving LPs a more predictable call schedule. Final thought, capital call timing is a tactical decision that sits at the intersection of portfolio management, fund operations, and investor relations. Most firms aim to be practical and transparent, using tools like forecasting models and credit lines to smooth the process. While preferences vary across funds and LPs, the general goal is consistent. Deploy capital effectively while maintaining trust and operational clarity.